big news if you guys are watching. The Fed set out their annual guidance for how they think things are going to play out into 2023. And Jerome Powell was asked today about some people who were speculating about rates coming back down in the second half of 2023. And he reaffirmed, this is crazy, today, live, there will not be any rate cuts in 2023. We're going to have more rate hikes into the first quarter, probably, of 2023. So in a few months, January, February, we'll have more pain. They're expecting a Fed funds rate of at least another 50 basis points. So probably 25, another 25 into Q1, Q2 of next year. But there will be a pausing and there's no talk at all, no consideration at all of any rate cuts in 2023. And I know that that's a big change, at least over time we've noticed. If you've been following the meetings, imagine if you just zoomed out and you heard the meetings like, a few months ago, say like in the spring, when they're like, it's transitory, by 2023, things are gonna be better. No. 2022, complete shit. Rates going up faster than they've ever gone up in history. The fastest hike we've seen in this shortest span of time. And it's still going. More pain. It's working. They're getting inflation under control. But the labor side, the services side is still struggling. There's lagged issues, and the economy is still, in their opinion, strong. So this was actually quite a surprise. I think a lot of us in the stock world were expecting that towards the end of 2023, we might have some reduction rates. No. 2023 is about hiking. We have more pain to come. If they reduce in 2023, it will drag this recession, inflation battle into 2025. We're now looking at 2024, 2025 as rates starting to come back down to normal. Fingers crossed 2025 we're back to how it was in 2020. What we know right now is that there's been pain, lots of pain. I think in the short term, the markets, just talking about like the stock market, real estate lags. So we're not going to know the effects of the hikes that they did today. As an example, there's 50 basis point hike today. Everyone was expecting 50 basis point. I know a few degenerate gamblers were expecting 25 basis points, but 50 basis point was pretty much the consensus by the Fed today. The Fed sets the global standard, right? They're basically the reserve currency of the world. They're like the new gold. And so basically every other country, unless they want their own currency to devalue, has to follow suit with whatever the Fed does. So that's why we watch as Canadians. That's why I watch what the Fed's doing. I'm very, cognizant of their impacts on our economy. And so we have more rate hikes to come, more pain, which is horrible because the home equity lines of credits right now in Canada are like 6.6% now. That used to float at like 3%. And so that's 140% increased cost. If you have a car loan or, any kind of loan at all, you have like any sort of, renovation loan in your house, a home equity line of credit, a variable rate mortgage, all of that is negatively affected and drastically. So that was pretty shitty. I know a lot of, it's interesting it depends who you follow. Like if you follow, economists that don't have skin in the game, and it's funny, talk about skin in the game. The Fed, before they started tightening, before they formed basically the council of people that decide in every single country who gets to decide on whether rates, go up, down, sideways, they all sold their equities at the top. And so they have no stock equities. So they have no vested interest they basically no conflict of interest. But it's funny because it's like their job was to destroy the stock market, destroy the labor market. And it's like they get to sell their stocks before they do that. Anyway, it's just ironic. I don't think there's any ill will there, but I thought that was kind of funny when you think about that. But yeah, we're definitely in a situation where we'll be in a rock and a hard place. And, it seems like there's, a good probability of a soft landing. I don't know though. Like that's the message they're sending. It's like, hey, we're doing a great job. We're beating inflation. We're gonna get back into 2%. Today, Jerome Powell was like very much adamant that, you're gonna have a situation where, that we're gonna get back to 2%, that it's happening, that we're not gonna get a wage price spiral, that we're not going to have these other things happen. Now, even if that was happening, even if that was, what he believed, he couldn't say it. He has to stay firm. He has to stay sort of hawkish, so to speak. He doesn't really have a choice. It's one of those things where like, if he doesn't talk dirty and doesn't, stay hard and mean, then the market's going to rally and then inflation is going to come back. So he needs to keep the consumer sentiment bearish. He needs to be hard so that people aren't, like tech entrepreneurs aren't hiring. They need to be not hiring. That's how we get inflation down. Right? To destroy demand, you have to basically hurt everyone and bring costs. To bring costs down, you have to basically just crush demand if you're going to attack it from a demand side challenge. So I think that's sort of the approach. So today was an interesting day. I went long. I went long yesterday thinking we'd get a Christmas rally, and I got punished. So I closed my shorts out yesterday morning. I saw everything spiking in the morning. I was like, I'm gonna close my shorts out. I don't know what's gonna happen, but I can't hold on through the pain of whatever's gonna happen. So I closed my shorts out. I'm a little bit long. I could be more long, but keeping a bit of cash back. I want to have cash in case I need to buy the dip. Want to have cash for liquidity purposes if the right real estate deals pop up. So in this time, more than ever, keep a little bit of cash. That cash is king. That's my advice going through all of this. Don't overcommit and don't put yourself in a situation where you can't carry your assets. Don't really carry those assets through these times because it's not a great time to sell. It's a great time to buy. And it continues to be a better time to buy. So I definitely think that that's something that's top of mind through this. And we've, now that we've had this meeting, the uncertainty's gone. We now know what the Fed is thinking. We know what every single person is thinking. We know what the Fed's terminal rate, what they think it's going to be into next year, how many more hikes we're going to get. They didn't give us any clarity on when they'll hike. They said they'll take their sweet time effectively. They're not making such sweet haste as they made before to get to that, to gap up the difference from where they think we need to be and where we are right now. They did say for sure we're not where we need to be. So more hikes coming in 2023. Whether we get a January 25 basis points, February into March, April, maybe another 25 basis points, 75 basis points, maybe into April, May, that would create more pain and exacerbate the already effects that we're feeling of what they've done so far. And even today's hikes, as an example, a lot of people have rate holds. So imagine if you jump 50 basis points like they did today, at 0.5%, that'll take time to trickle down and cause the pain that it needs to cause to bring down inflation and curb people's spending effectively. What they're trying to do is curb people's spending, but not so bad that we go into recession. And so they're like, hey, next year our guidance is 0.5% growth for the US economy. And it's like, that's as close probably as the Fed can get. I don't think the Fed will ever come out and be like, we're expecting negative growth for next year. It's just, they just can't. Their job is to crush inflation. So they need the economy to be strong in order to crush it. So they will focus on data and they'll focus on opinions that support that thesis so they can do what their job is to do. They really don't give a shit about the average person struggling to pay for rent or groceries, or the real estate investor who's suffering, or a person who has a giant mortgage, or anyone who's tied to any business that has a lot of debt, or that's has to work in an environment where they rely on debt to capitalize their assets. So they're not focused on that at all. They don't care about the stock investor, none of that. Their sole focus is get inflation back down to 2%, make sure it's not sticky. Because the longer this inflation persists, remember, we had inflation into 2021. We had crazy inflation. They called it transitory. In 2022, the narrative changed from transitory to, oh shit, it's not transitory. So you've had crazy high inflation for well over a year now. At a certain point, it becomes sticky and it becomes hard to battle. And certain core inflation pieces take longer to battle than other areas. And so certain sectors, as an example, you get wages. If the consumer sentiment is that inflation is here to stay and we're going to stay much above 2%, their target is 2%, but let's be honest, we're probably not going to hit 2% real inflation, in a long-term stabilized market until at least 2025. I think even if we get there, we may actually have deflation. It's possible you have deflation next year, that they over-tighten. They keep going with the rates. The hikes, into January, another 25 basis points, maybe sometime in the spring, another 25 basis points, into the summer, maybe another one potentially, and then they pause. And they're like, geez, let's see what happens. And so it takes sometimes 6 months for the effects of those higher rates to crush employers so they can go bankrupt and lay people off, and then there'll be no money to spend. For entrepreneurs to feel the pain of it, for homeowners, oftentimes takes the bank 30 days to send you out notice and increase your rate. It can take time before you feel the effects. Remember that in Canada, as an example, people renew their mortgages. Most people on 5-year fixed is the most common. About half of all mortgages in the last 2 years are variable. So those people are getting, their mortgages are going to reset soon, which means their payments are going to jump. They have static variable rate mortgages that soon jump. My own included is about to go through a static variable jump on my own house. It basically just means that rates have gotten so big that the payment you were paying before is more than 100% interest, they have to now jump your payment up to afford these new rates. So it's very, very common that'll happen. But remember that about, on average, 20% in any given year of mortgages renew. And so if you're locked in and say 2018 at a 3% mortgage, and now it's 2023 and your 5-year mortgage is up for renewal, even though you own your house, you still have to refinance that mortgage, and now your mortgage payment is double. So you go in for a refinance, you're looking at paying double what you were paying before potentially. So that'll have effects as well. And so in 2022, we got 20% of mortgages renewing, 2023, 20% of mortgages renewing, and then all the variable rate mortgages. So 40% of all mortgages are renewing, plus other people buying properties, plus anyone who's renewing for other reasons, like they renovated their house, plus anyone's got any variable rate products. So a large percentage of the debt market is going to reset at these new rates into 2023. We'll start feeling a lot of that pain. And so there are lagged effects of their decisions. And so it's just something to be cognizant of. And I think the Fed is very cognizant of that fact. And that's why they said they're going to be slowly, working into raising more rates into the new year. But it's clear that they haven't done enough. Annual inflation is at 7.1%. If you annualize just the monthly within this last 90 days, we are trending down. I think it's possible we go through some deflation. We want that really, because the price of everything has ballooned 15% in the last 18 months, let's call it. Really, what we should have is deflation to fix that. Now, it's painful for an economy to go through that, but we really actually want deflation because we want to fix. This was supposed to be transitory. This was supposed to be done by Q1 2022. And now we know it's going to go into probably 2024 before we get inflation back down to target 2%. And so really, if inflation lasts 2.5 years, then maybe the Fed's like, oh, well, inflation's fixed, no big deal. And like, too bad that prices have now jumped up like 15, 20% over the last 2-3 years. We're just going to leave it. What they should do is fix it, but they're probably not going to do that because deflation is so painful. Realistically, the inflation that's already happened it'll just have happened, and all prices we'll just get used to it being higher. The hope is that wages catch up but don't exceed. The challenge is wages need to catch up, right? You can't just raise the price of everything over a 2-year period 15%. Like we've had over the last 2 years, probably close to real inflation of about 15%. Call it 7.5% a year. At certain points it was more, depending on which months you were looking at, but roughly in a 24-month period, like 15%-ish. The shadow inflation is probably closer to 20%. If you look at, depends on which segments you're looking at. I guess if you look at like, technology, like TVs, they drag down the average, right? You're getting more TV for the lesser price. But anyway, yeah, so that's my thoughts on the matter. I do think the government likes inflation. And so in general, inflation is good. Remember that politicians love inflation because it's a way to tax people. So inflation is the greatest way to tax people without raising tax rates. If you have say you have a property worth $100 and they inflate the value of the property worth $200, so all the properties are worth $200 now. Your buying power is the same. If you go sell that property for $200,000, you can still buy all the same house you could before, all the same goods that you could before, maybe even less of it, because your property went from $100,000 to $200,000. You have a $100,000 gain. But so now the government's going to take up that $100,000 gain, maybe $40K of it. So now you have, instead of $200,000 house, when you sell that, you have $160,000 left. So your $160,000 can't even buy you back the same house because the capital gains taxed you. So the government loves inflation because they can tax it. They don't want too much inflation though. They want price stability because no one can do business in an economy where prices are rising crazily. You can't price out a job, a contract job 6 months from now. When, but apologies by the way for, above me, my kids make forts. And so they're always like dragging, items and things to build these crazy forts. So what you're hearing above me is my 3 kids going wild. If you can hear, I don't know if the camera speaker is that good to pick it up, but that's what my kids are doing right now. They're dragging furniture all across the floor. That's why we put these felt pads on all of our furniture because otherwise it would destroy our floor. So anyway, back to the inflation discussion and the tough talk that we got. It's definitely something we're thinking about as investors going into Christmas here. I was hoping for a Santa Claus rally, to be honest. That's why I closed my shorts out yesterday. I saw the 3% jump, and it was stupid of me to close out my short. I closed it out for a small loss, but I was like, you know what? I'd rather take a small loss. I'll short again in the new year. Into earnings season, I think what we're going to see is month to month we're seeing a lot less inflation when it comes to supply side goods. We're still seeing squeezed margins. So I think the retailers, a lot of them potentially into next year are going to have lower margins and they're going to feel the effects. Like this year, the reason Black Friday was so strong is because of inflation, right? So it looked like we had record Black Friday, but it's like when you factor in for inflation, we actually didn't have any record sales. So I think without inflation carrying them, because now the Fed's talking dirty, they're getting inflation under control on a month-over-month basis, hopefully. That's going to result in shitty earnings for these companies. So we're going through an earnings recession. following. So the next Q1, Q2 are going to be really rough. We're going to have a lot of volatility. I think it's not quite time to go in long yet. I think it's still time to stay on the sidelines with cash or be shorting if you have the balls for it. If you're going to short, make sure you stop loss out. Stupidly, I stop lossed out yesterday at plus 3%, and then halfway through the day, if you watch the NASDAQ, it just ripped down like 3%. I was like, no, like I literally did it like right at the top. It's just the worst timing possible. It reminds me, and should remind all of us, that none of us can time the market, and that timing the market is near impossible. There are a handful of traders in the entire world who have been able to consistently, over a 25-year period, beat the index. So just remember that when you're building your portfolio, it's very hard to beat the index. You probably won't beat the index, so you might as well join them and buy the index. Now, that doesn't mean you can't use leverage to potentially amplify returns. That doesn't mean that you can't, certain investors have timed the market in such a way that they've way outperformed. You know what I mean? Like through the right, like say you started trading like at the bottom of the market. Well, then you're gonna have your first 2 years like a 50% rip up in your return because you bought it the best possible time. And that if you have a large capital base, and you have a 50% rip at the start, that is such an impact because that 50% growth compounds for you over a 25-year period. But if you adjust for all traders through all times, through all different trading periods, statistically the worst time to start trading is roughly when I was trading, the end of 2021 into 2022. I dumped a bunch of my properties and put it into my stock portfolio and bought crypto and growth stocks, which is in hindsight very stupid. But again, picked the wrong sectors. I should have been more balanced. I should have been more diversified. I took from my dividend portfolio to top up on my tech portfolio, my crypto holdings. That was probably poor timing. Again, it's important to have different asset classes, different sectors. Thankfully, I'm not wiped out. Crypto has dropped 85% from its all-time highs. If I was just a crypto bro, that would destroy me, right? But I'm not. I've got my dividend stocks. I've got my real estate. I've got my different asset classes, my private lending, and different areas that I invest in. Now I have tech as well. Too much tech probably. I was probably heavily weighted into tech and crypto, but I've rebalanced for that. And I think that if anything, coming into this recession in 2023, we're going to see, or at least the further dip, because just remember, guys, every single recession, if you look at the VIX, the volatility index, is the best, the VIX is a ticker, is the best possible, sign that we have to gauge when we're close to a bottom. Now, it's impossible to predict the exact bottom, but what we know is that every single time in the last 50, say 30 years at least, I looked at that. I looked at like the .com, the 2020, the 2008, the last 4 or 5 recessions, VIX is always above 35 and usually above 40 or 50. So we haven't seen that. We haven't seen the NASDAQ bottom out at the same time as it being well above 35. And I would say above 50, really. We haven't seen that yet. So I think we're still not there yet. We're in a bear market. And we're in a bear market rally right now, and I think that we will have further pain. We need some catalysts for further pain before we really want to buy at the bottom. But remember, this isn't the time to walk away. This isn't the time to say, bury your head in the sand and say, I'm not going to own equities ever. I know a lot of you are feeling the pain that I'm feeling today, and it's like, you bought your Meta at $300 a share, and now your Meta is $118 a share. And you're like, shit, I've lost 2/3 of the value of my portfolio. If I put $1 million in stocks like Meta or Nvidia or a whole bunch of names, tech names like Intel, where your portfolio might be half or less. And it's tempting to want to just sell everything and walk away because you're capitulated. Capitulation is basically the point at which you can't take any more pain. And so you basically walk away, right? Don't walk away. Zoom out, hold on, be diversified, and long-term you'll be fine. So don't have it all in Meta, rebalance obviously into many different players in that sector. But if you rebalance and you hold over a long-term, companies like Meta, Intel, they'll come back and they'll come back swinging, right? They'll see all-time highs again. We might have to wait 5 years. So that's something to remember through these times is that when you zoom out, I'm a long-term perma bull. Like no matter what, you should be a bull in the long term because inflation carries all assets, and just in general, all assets appreciate over time. And so it might look like this, but if you zoom out in the chart, it always looks like this, straight up. So just remember that over the long term, you'll win if you're diversified. Don't put it all in one company. Don't put it all in 10 companies. Spread it out, build a diversified portfolio of quality equities, and you'll be just fine. And continue to dollar cost average in these times. And remember that cash is king. So that's my market update for this week. I just wanted to kind of start with that and the pain and how it ties into real estate too. More rate hikes are obviously not good for real estate. Real estate investors typically aren't very sophisticated. So you got to remember that most real estate investors aren't forward thinking. And so same with look at all the realtors. Most of them don't have an economics degree, don't understand economics. For the most part, most of them don't even know whether there's going to be this is weird, but I patrol or watch a lot of realtors on my Facebook channel. I've got thousands that I'm friend connected with. And I check and I see their comments. I've got 1,000 other realtors commenting in these groups on these posts. And it's as an example, today's rate hike. There was actually a discussion in a couple of realtor groups I'm in where people are fighting whether it's going to be a 25 basis point, 75 basis point. Some people are hey, it's going to be no hike tomorrow. The economy's in shambles. And I'm these people are real estate professionals. They guide the price of real estate and they convince their buyers to pay certain prices. They basically control where the price of real estate is going to be. And these people have no idea. There was a 0% chance of it being zero today. That isn't even a possibility. And I had realtors posting in the group, oh, rates are coming down in January. We're going to see 1-2% drop in rates by January. I'm that's just false. And these people are experts in their field. And some of them are top performing agents that sell, tens of millions of dollars in real estate a year. And I'm they're just stupid. Not stupid. That's the wrong word. They don't understand economics. And so with real estate, because there's so much lack of sophistication, you can arbitrage. I love that about real estate. In the stock market, markets are pretty efficient. It's hard for me to go out and buy shares of Intel or Apple or, Tesla at a big discount. Most investors don't, if Tesla's trading $100 a share, let's just say hypothetically, it's not, but it could trade $100 a share in the next little bit. And let's say I offer someone $80 a share. No one's going to take me up on that. There's a perfect, efficient, liquid market. But in real estate, someone who's desperate enough to sell right now, who can't afford the payments, who's feeling doom and gloom or had a death or divorce or, one of the 10 Ds in their family. And so they come to you and I say 80 cents on the dollar, can you close next week? And I'm yep, done, sold. I just bought 20% discount. And then on top of that, I can sell it if market price is 100. I can convince someone who's emotionally attached to that property to pay $120 a share, in theory, for that said property. So I could buy it for 80 off someone and sell it for 120. You can't do that in the stock market. You can't control buying at a discount and selling at a premium. You can do that in real estate. It's business. And so that's what I like about it. One of the things to be cautious about in these times is that fact that I just mentioned, that realtors don't know what they're doing and they're guiding their clients with bad knowledge. And so that's why in 2008, when the housing market collapsed, it took until first quarter 2011 before we saw the bottom of real estate prices. 2008, the world collapsed. By 2009, everyone was shit, the markets were in free fall. We knew that real estate was fucked. And it still took another year and a half before we saw the bottom on average prices of properties sold. And part of it is because mom and pops, unsophisticated investors, there's just a lot of it. There are a lot of people a lot of international capital, from India, China, that come here and just buy properties in cash. Just on the full guise of some realtor who's a family connection wanted to make a commission and told them to buy a new build property. And there's a lot of that in the market where people are just dumb and they're speculating. And so those people have a lot of cash. Maybe they can hold the property for 2-3 years. And so they'll rely on bad information until eventually the writing's on the wall. And it takes time because something that sells now doesn't become a comparable and affect the price for the 120 days. But a share sale that happens now in the public markets, it instantly affects the price. If Elon goes and dumps 1% of his holdings, it affects the price drastically. And he might be doing that to support his Twitter habit, or Twitter revitalization, sorry, not habit. But he is dumping cash into that business, right? And so when he does that, it's publicly disclosed, everyone knows, and it affects the price immediately. But if Elon sells a bunch of properties quietly, no one would know. The real estate market isn't efficient. There is no open exchange for real estate. And so because it's an asset class that's relatively strong, stable, and you can hold it and cash flow it in a way that you can't with stocks. You can get a dividend from stocks right now. You could probably get a 6 or 7 or 8% dividend. But that barely beats inflation. With real estate, in certain sectors and markets, you can buy 14 cap properties right now. In Florida, I'm looking at some stuff, not in the best areas, but you can find properties that are, yielding 20% cash on cash. And if you lever up that, you can get some of those properties to 40, 50, 60, 70% annual ROI if you do a lot of the management in-house and hire some VAs to help carry the load. That's something you can't do at that same risk level in stocks. So that's why I like real estate as an asset class. It's also hard to fuck up. It's really hard to mess up if you have a portfolio of properties. You can just hold, and even if you get a bad deal, over time you win. Like 20 years from now, the price of everything selling today just looks so low, right? Like go back to the 80s when the world was falling apart. Like there were houses for 80 grand, 70 grand. They're now worth 400,000 or 500,000. That's just the difference. And so it'll be a crazy time. If the Fed fucks up this soft landing and we end up in a 1980s Povolka type of era, I don't think that'll happen. But let's just say the Fed fucks up a little bit and we get a wage price spiral and rates go to like 10-12%. Try to carry properties at like the Voca area. It's just like try carrying properties today at these prices at those rates. It's unreal. Rents, it should drive rents up though. So I mean, if you're holding the properties long term, your rents should rise. So I mean, it's a shitty time in general to own any asset class as rates rise. Every asset class is pretty much destroyed. Bonds wiped out, stocks wiped out, dividend stocks wiped out. Because again, capital should flee to bonds once the bonds are destroyed. The bond yields get so high that they are more attractive. Real estate crash against interest rate rises. But in real estate, despite the asset class falling, I can arbitrage. So they could be falling, but I could get a seller to sell me here. And so even though the prices are falling, I can get back out of that asset and still be in a win, right? I can still make money. So I can still flip in this market. I can still, I'm successfully flipping still. Despite the prices have fallen 30%. That just means I buy it at a 50% discount. And then as the prices fall, there's still profit margin there. And it's way better if you're able to hold those assets through the long term. So that's my consensus. Let's go to the Q&A. Do some Q&A for you guys. Will retracted his message. Good to see you on, Will. Troy says, does that mean there will be higher tolerance for inflation by the Fed for 12 plus months? Or if inflation subsides, will they cool off interest rates? Troy, I think that they're going to wait heavily on data. And that's what they've said today is that like the data drives the decision. Which data pieces they're going to point out and focus on, that's still, I mean, not entirely clear, but my understanding from what they've communicated is that they're very closely watching the labor market. And that seems to be their strongest indicator. And so what they're looking for is they don't want to, the rock in the hard place is like, if they tighten too hard, what we'll see is basically the labor market gets destroyed. People get laid off, no one has any money. Inflation falls, but then they've created a full-blown recession. And if they tighten and they raise rates too hard, we have a full-blown depression. They crush everything. The Bank of Canada is running at the biggest loss it's ever run at. It's like the government has to bail them out effectively. Because remember, the Fed, like the government actually has debt that they have to sustain. And how long can they sustain it for? They can't carry this enormous debt load on the current, I guess, the current rates that they're forecasting. And so rates have to fall long term, hopefully. I forgot the second part of that question. Let me go back to it here. What it means, Troy, I think, is that the Fed is committed to getting inflation down. I think that we'll see, if they were, the problem, Troy, is that if they decide into Q2 next year, they say, hey, we're going to lower rates. The market's going to rally, people are going to spend, businesses are going to hire, there'll be money everywhere. Because it's like, hey, the recession's over, let's all enjoy. The bull market is back. And so that will lead to a ton more inflation. That's a challenge. So they can't waver in their dedication to get inflation down. They can't waver in their hammer that is rising interest rates. They need to stay strong. They need to stay hawkish. Even if they're going to pivot, they have to stay hawkish. We have to believe, invest. And it's funny, after the Fed spoke today and said that, he literally said, he was asked, what about investors who are, I think the question was, you can go listen to it today, but I think the exact question from the reporter was, what about investors and people who are, expecting rate, declines in the back half of 2023? And he was like, we're not even thinking about rate declines at all in 2023. We're looking at hiking in the first half of 2023, and then we will wait and pause. So it looks like that was squashed, any hope. But you look at the bond yields and treasury yields, the market doesn't believe him, right? So we'll see. We'll see what happens. If we go into a deep recession, they will have to print money. Or they could lower interest rates, either or. It's effectively the same thing. It drives inflation back up again. It's really hard to fix inflation without destroying the economy. So it's like, like it's the rock and the hard place everyone's talking about, and like navigating a soft line between a rock and a hard place. There's a very good probability they'll fuck it up in the next year, and so I think we'll see a lot of volatility next year. I think we'll see a lot of pain. There is a small probability that they land the plane perfectly. You know what I mean? And they get inflation under control and rates come back down. It's a low probability. I wouldn't bet money on it, but it's possible. Next question was, hope the Canadian dollar strengthens soon. $200 a day for pass to Epcot Disney. Well, that sucks. I'm also going to Florida. I leave. I'm going to be doing a bunch of deals down there. I'm excited for it. I love Florida. We go for every winter. Summer warm. We don't want to be in Canada in the winter. And I'm leaving December 27th, 28th-ish. I'll be there through till probably April. So you best be able to connect with me in Florida if you're in Florida, and do some deals down there. I'm excited for that. What was my point I was going to make? Oh, Disney. We go to Disney every year. It's great. The Canadian dollar sucks right now. You're totally right. I haven't checked it today, but it was like $1.36. A US dollar buys $1.36 Canadian, which is horrible. I should have hedged because I have a huge US obligation I have to close at the worst time possible. So it's definitely, I'm definitely acutely aware of that fact, that the dollar has to, like the US dollar should fall. The problem is that all these other countries that rely on the US dollar, they're having hyperinflation, like Argentina, Turkey, all these like random, even Europe, we've got double-digit inflation. And so the US dollar, people are flocking to it because they think it's safe in these times. And so there's so much demand for US dollar and instability. It's directly correlated with how the markets are doing. So the stronger the markets go, the better, I guess, the better the Canadian dollars, the worse the US dollar is in demand. And so then you'd have better buying power as a Canadian. It's also interest rate tied. So if the Canadian government gets smart, the problem is Canadians have so much debt that we can't really keep up. What we want is Bank of Canada to hike harder than the US. The problem is when the Canadian dollar gets stronger, it'll hurt our exports, right? It's good for imports, but it's horrible for exports. And we do a lot of exporting. So I think that they probably want to keep the Canadian dollar, just from an export perspective, the government probably wants to keep the Canadian dollar a little bit weaker. I don't know. It's tricky. There's a lot of things that go into play, right? A lot of factors that go into that decision. Hey, how you doing? Eric says, thanks for this great advice. Just want to come say hi. Thanks for listening. Thanks for joining in. If you're watching right now, smash the like button. That'd be cool. REI says, Mike, you said last year a 20% drop in real estate would be astronomical and never happen. The Canadian economy is so heavily based on real estate, the government would just step in. Eating your words or what? Okay, so when I said that, prices were here. And roughly, from that point last year to March this year, we had a 30% rip up in the average Ontario price of homes. We've now seen 25% pullback on that. We're still above where we were. Do I think from this point it's possible we fall 20%? Yes. More than 20%? No. So from where we were in March of this year, that would be like a 50% drop from where we were in March of this year. Because you gotta remember that it looks like basically like a giant upside down V for the price of real estate in Ontario. It got bubbly. It effectively was a bubble. We had speculation and people rip prices up to new levels. So will the government step in if prices fall to a certain point? Yes, 100%. With everything that they can do, they will do. Prices of real estate can't stay low for long. They aren't low. They're still high, really high, relative to where they were. Like if you go back 5 years as an example, what the government wants is what they did in basically the 90s. In the 90s, they kept interest rates a little bit higher. And if you remember, 1990 in Ontario and Toronto, let's say, you bought a house in 1990. By 2000, 2001, you had no appreciation for a 10-year period. That's what they prefer, is a flat. So I think at this point, we could have a little bit further pullback in Ontario real estate prices, but I see us more stabilizing. We had a rip up. We had a correction for that, insane hype. A lot of it was foreign capital pouring in and speculating. And so that's corrected in a lot of ways. And these higher rates have forced prices back down. People aren't speculating in the same way that they were. Over the long term, inflation will carry real estate prices up. And so over a 5 or 10 year period, you win. You can't go wrong buying property that cash flows that you can hold for long term. If you're flipping, flip cash flow properties. Flip duplexes, triplexes, large multi. You flip that stuff, you're cash flow positive. You can't lose. If the market goes down, you hold. You're cash flow positive. Run your rates, run your sensitivity analysis in your spreadsheets. You got to run your sensitivity analysis at higher interest rates. What happens if this happens? That's what sensitivity analysis is. When you're underwriting a deal, the most important thing you do is underwrite it properly. Most people don't. Most people don't underwrite their deals at all. Like, I like this property. It makes sense, and they buy it. And it's like, you didn't underwrite the deal properly. Did you factor in if rent rates double? Did you factor in if this happens, if this happens? Do you have contingencies? Do you have reserves? All that's really important. A lot of real estate investors right now are getting spanked, but no one who's been in the business 5 years plus is getting spanked. Like, any of us who have been real estate investors and had significant portfolios for the last 5 or 10 years, none of us are hurting. We're all doing just fine. Now, people who maybe had portfolios for a long time, but then overextended into this bull run that we saw. Like, I mean, when I say overextended, I mean levered up to the tits, borrowed private money unsecured, levered up first and second mortgages on properties, and bought a whole bunch of stuff to flip or that didn't cash flow into January, February, March of this year. They're feeling the pain now because their equity's gone. You know, if they bought, and we've seen a 25% pullback, if you put 100,000 on, you know, on a property worth 200,000, let's say you did even 50% loan to value, you've lost some of your equity there, right? If you bought it at 20% down, now your equity's completely gone. So that's the big difference with leverage. But in my own words, to an extent, yeah, I'll stand by what I said a year ago. Before, because you got to remember that in the fall, like, if I were to sell a property right now, it's the same as what I'd sell it for a year ago, a year and 2 months ago. Prices are the same. Like, all my property, I sold a whole bunch of properties off last fall, and prices are about the same as what I was selling them for last fall. Now, I wish I would have dumped a bunch of stuff in January, February into March, especially because I would have got even better, rates, and I would have even better, terms on my deals and made more money. But I sold at a good time. I was cashed up. Unfortunately, I took that cash and I bought crypto and growth stocks. But I still have a lot of it, and I have no regrets, really. It's better than if I had, well, it's about the same as if I'd held those properties probably, but I don't have the stress of having those properties anymore. I don't have the headaches to go with that. So overall, to win. Do I think the government would step in? Yes, 100%. If we see from, I guess, the last part is eating your words. Yeah, to the extent that, by the way, I'm not always right. None of us are always right. If any of us were perfectly right, we would, be all billionaires, right? I have to be right more than I'm wrong. And I have to make cognizant decisions based on data. And so from what I've seen, because GDP is so heavily tied to real estate, if prices fell more significantly than they haven't fallen that hard. Like I said, it's a V chart. Like, if you zoom out 2 years, prices look like this, straight up. Like, it's still unaffordable and things are still crazy high. When I was investing in 2016, 2017 in London, like, I'll give you an example. I built a house in 2015. In 2015, I built a new build house, and it's in a nice area in Northwest London. It's like, I can't remember the square footage anymore, under 2,000 square feet-ish, but a nice new build house. And in 2015, I built it for $318,000. I negotiated a really good deal with the builder. And I sold the property in 2017. I lived there for 2 years, and we sold it. I had to roll the capital into something else, and I couldn't refinance it at the time. And so I sold that property for $405,000. It's at a record comp. That property today is just changed hands for $940,000. That's with the dip. Maybe in the 800s now. Like, it's still insanely high from where it was, right? And so, is it possible that a crazy bubble can be corrected? To an extent. Some of it's inflation. A lot of it is supply side materials have gone up so much in value, and labor is just so much more expensive. Like, I could hire trades guys for $20 an hour back then. Now I got to pay them 30 at least for the same quality of work. That's a 33% increase. So a lot of that gets passed on to the build cost, and we will see builders and developers go bankrupt in this time. They're most sensitively affected by this, and if enough of them go bankrupt, the government steps in. It's true. Enough of them aren't going bankrupt. Enough of them have a lot of money still, and so we need more pain to really have the effects of the government stepping in. So could the government step in? Yes. We need more pain, and it takes longer for them to step in. But that's the rock and the hard place. We're getting close to that. Like, they're now landing the plane between the rock and the hard place, and they get to the hard place, and that's, I call the hard place recession. The hard place is they print money and they fix the solution, right? the rock is the inflation gets out of control, and both are shitty. But that's where we're at right now. None of us really saw this coming to that extent. Like if I had seen, interest rates staying this high for this long, I probably would have fixed stuff in. It did fix in some mortgages, but I would have fixed in more. But I like to live on the edge too. I'm like, you know what? By 2024, if I averaged out, variable probably wins out. I think now over a 5-year period, variable will win out, but over a 2-3-year period, it'll lose out. So that's okay. Garinder says, hi, Mike. Thank you for hosting. Do you see Tesla going under $100? I don't know. Garinder, I think that, any of the tech and the growth names right now are being heavily hit and are heavily sensitive to the rate hikes. As rates hike, there's less capital for them to raise. They need capital to grow. And so the valuations when there's less capital pool, the valuations have to get much, much richer. And so to get the valuations richer, you have to raise the long-term discount rates that you use and the long-term terminal rates that you use. And when you raise those, that changes the calculation dramatically for when you're discounting the future cash flows of that business. And so for that reason, these companies will suffer until rates come down. And so I wouldn't be super, if you had a short time horizon, you're like, hey, I need this money out to buy a house next year, let's just say. Would I put it in Tesla? No. Would I put it in Meta or any growth tech stock? No. If I had to have the money for next year and I didn't have a 5-year time horizon, that would change the way that I invested big time. Now, if I have a long-term time horizon, I'm gonna start buying names like Meta, Intel, trading at 7, 8, 9 P ratios. They're generating quality cash flow. I like Tesla for what they're doing. I like the way they've changed, everything as far as the EV landscape. And I like what they're doing with their Tesla robots. And I like a lot of what they're doing. The competition is at their heels, biting and chomping. The only thing that they have currently that's better than the competition, in my opinion, is not the build quality of their cars, because their cars are not as good. Mercedes is a better EV vehicle. A lot of vehicles have longer range than Tesla now. And that's coming. They're eating their lunch soon. But what they have is better autonomous driving. So I think that, I do think that Tesla there's a real scenario that Tesla could have their lunch eaten. Especially with Elon not laser focused on the company anymore. He's focused on Twitter. And so that divides his attention, and that could have real negative effects for, the growth trajectory for Tesla. So while I love what they're doing in this space, and I love that they were able to defy odds, they were a negative cash flow company just dumping cash into their business. And it's lucky that they were able to, what they're good at is their manufacturing process is just, fantastic. Their cost base is great. So I would say that, maybe. I wouldn't have it as a large percentage of my portfolio. I disagree with Kevin on that. I love what he's doing, and I love his channel, and I love all the advice he gives. He's wrong, like me, also wrong a lot. And that's not his fault. It's just impossible to be right all the time. None of us have any idea. But, a lot of the best analysts I follow don't have great track records right now. And that's because we're going through unprecedented times. That's why it's important to diversify. It's important to have, to not make stupid decisions. Carefully calculated. Diversification is important. Don't wallow in on one asset class, one stock. Hey, David. How you doing from Alberta? Aiden says that with the many variable rate terms that will be renewed in 2023, do you think today's interest rates will have a significant effect on those homeowners? So let me put it this way. Current Canadian mortgage default rate is around 0.6% allocation, a little bit less than that, less than 1%, well under 1%. It's possible that half of all mortgage holders are now at double the interest rates. They're paying double the interest cost to carry their home. And for their car and for everything else that's variable, and their credit card debt and everything else is all, their line of credit, all of it's up. And at the same time, people are getting laid off and real estate prices are falling. And there is a large number, we'll call it 10 or 20% of all properties that are currently underwater, roughly. And now if you factor in that this year and next year, 40% of all fixed rate mortgages are renewing. And over 50% of all mortgages in the last 2 years are variable. They're all feeling that. So we're talking about a pool of mortgage holders of about 60% of all mortgages are affected by this. And we'll say of those, maybe 30% of the entire, so half of those people are going to be affected meaningfully enough. Like someone like me, I'm affected by this. My mortgage was a 1.26% 5-year variable. It's now, probably 5% or something. So it's triple. My interest payment every month is triple what it was, 9 months ago, let's call it. that doesn't affect me at all. I have so much equity in my house. My house worth double what I paid for it. And so I have a bunch of equity in my house and I have tons of cash flow and reserves. I'm a wealthy individual. It doesn't affect me at all. Like, it sucks. My mortgage payment's now double or triple or whatever. Who cares? Doesn't affect me. I'm an example of someone who's affected by it, but that it doesn't lead me to sell. So it creates no effect on the real estate prices at all. I just survive through this. Long term, I hold it. I sell my property in the future when prices have come up. But there are people out there who aren't like me, who don't have money, and they're living paycheck to paycheck. Those people are going to suffer. And so all we need is about, of that 30%, we need 10% of those people to default. 10% of those people who are affected, those 30%. So there's 70% of people who won't be affected greatly. I'm in that category. And there's a bunch of people who have, bought their house 10 years ago, and so their mortgage is small. Maybe they refinanced their house to do renovation, but it's still not going to affect them enough that they're going to have to sell their house. They're going to find a way to get through this. They're going to pay for their house. It doesn't affect things. I mean, they'll have less money to spend on vacations, luxury, Airbnb. All those segments will suffer. Travel, all of that will suffer, but they'll keep their house. So the real estate prices won't be affected by them. But there'll be a portion of that 30% of the default. Let's say it's 10% of those people in that at-risk category actually default. That's 3% default rate. CIBC Bank, like one of the big 5 banks, bankrupt, insolvent at 4 or 5% default rate. I'm just saying, that's a possible scenario. It could happen. Hope it doesn't. I think the government will step in and they'll not allow that to happen. But in those situations where that starts to happen, the government will step in and will save the market. So I don't think we have that much more to go. I think we could probably see another 10% drop. So if buy a house for $1 million, it could be worth $850, $900, into next year. That's possible. But that's the most I think we're going to see. I could eat my words, but that's where I feel like it's going to be in next year. That's the worst case scenario. And there's a lot of upside, I think, coming as well. So let me do some Q&A real quick, and then I'm going to wrap up the stream. My thought is that many of these mortgages are locked in at prices from above up to 5 years ago, which were a lot less compared to last year's bull run. So Aiden, to go to your point, remember that even if someone locked in 2020 at a good rate on a 5-year, they're now at 3 years left, right? And so if they renovated their property, need to refinance, higher rate. A number of reasons why they could have to go to a higher rate. They want to buy a house to buy something else. They have to move for a job. So really it does, yes, it affects mostly people who just bought. And because more than half of all mortgages in the last 2 years were variable, it affects those people more acutely. So yes, we're focused on that specific segment. And all we need is 10% of those people in that 30%, 10% of them to default for us to have major problems. In combination with all the builders, developers who will all go belly up as well, who are highly sensitive to this. So that's all we need to have a bit more of a dip. And so I think it's possible that that happens. But remember, over the long term, over a 5-year period, if you bought a property, you can cash flow, or even if you're not cash flow positive, let's say you want a variable and rates get up to another 1% higher, and you're like, I'm break even or not making money, hold your property. At the bottom of the market is not the time to sell it. Even if you're cash flow negative a little bit, you will be cash flow positive later, right? As rates come back down, and they will come back down. So potentially, if you have the liquidity and you don't need to sell the property, hold it. Because over a 5 or 10-year period, you're going to win for sure. Food for thought. Food for thought. Long-term bullish, remember. Short-term bearish. I'm shorting, but I'm long-term bullish. And everyone should be long-term bullish. Benefitness Studio says, evening Mike, who do you use for insurance? I have 15 properties and was wondering how I can optimize. I use a broker. So go find an insurance broker who can shop you around to a whole bunch of different insurance companies. Someone will take on your portfolio. I think I pay like a little over $100 a month per property. I pay super low insurance. I talked to a guy who's paying $350 a month. Now, I also have a $5,000 deductible on all my properties. I have $2 million liability. Probably should have more per property, but it's more than the standard $1 million. So I doubled whatever the standard was. It's like, give me twice as much as what standard is. But yeah, I think my insurance is pretty bare bones. Like if there's a flood or something, minor happens, I'm never gonna make a claim because the cost of the claim over a 5 or 10-year period is gonna cost me more than just fixing it myself. So I've had floods. I've had a fire at a property too, and I was able to just repair the kitchen, no claim. I had a flood at a property, just took the rips of the floors out, ripped the trim out, cut a little bit of the drywall, replaced it. It was like $7,000. The claim would have been like $50,000 because I can do it for a lot cheaper than the insurance company can. They bring in like these, the expensive contractors that soak everything. So I just don't make claims for small amounts. And so I believe insurance is there for emergency situations. Someone dies of your property, someone gets really hurt. The liability piece is really important. So that's why I use my insurance. And so that's why insurance is cheap for me. but definitely shop it around, because I use cooperators with my house and my cottage and a couple other, I have a triple discount thing. So I have some small life insurance policy for my daughter, a whole life policy. It's like the bare minimum, 25 grand. And when I got her in policy, I think I paid like $350 a year for it. My insurance dropped by 3,000 a year. So her putting on I got a triple discount. So by having life insurance, car insurance, and house insurance all together, the cost of my house insurance dropped so much that her insurance was free and paid me a 10x return to add life insurance to the bundle. That was an interesting pro tip, I guess you call it. But yeah, watch your costs during these times. In a recession, cost control is so important. More than ever, you gotta be frugal like Mike. You know, I'm very frugal. I'm very much focused on cost control. I'm not letting my property manager call up an $80 an hour plumber. I'm calling a $30 an hour handyman to fix my stuff. I'm keeping my maintenance costs super low on my property while keeping it in good condition. I gotta find the same way to do something for less. How do I get the same repair done for a third of the cost? The property manager doesn't give a shit, right? It's not their money. So they're gonna call up Enercare to fix your furnace at $100 a service call, plus parts marked up 80%. Or they're gonna call, you know, ABC Plumbing, that's gonna be $150 for a service call. When they could call a handyman and coordinate something and get it done for $30. Now that's a lot of work for them to find a list of handyman and then go through those lists, because you're gonna burn through those people. Those contractors that work at that price, they're transient. So they're off their way to Alberta, they're gone after a year, you know, they're there for somewhat, the reliability isn't always as good, but you save a lot in price. And at scale, that's significant amounts of money. All right, I gotta go faster here. My wife just texted me. She said it's my daughter's bedtime. I gotta go. I'm gonna go really rapid fire. Will says Argentina is getting killed with inflation. Hopefully they win the World Cup to bring their citizens some joy. I have a buddy who's Argentinian, and for him, I'm hoping that they win the World Cup too. I don't watch a ton of football or soccer, I guess you'd call it. But you know, I love to play. So, will Orlando be a leisure visit in January? Okay, so hey, well, I'll see you in January. Frank says, if you're cash flowing on a property, is it a good time to lock in for a 1 or 3 year mortgages? No, Frank. I think we're getting to a point where it's getting too expensive to lock in. Into next year, I think probably smarter. Okay, so you'll win if you do a 1 year fixed, I think. The 1 year fixed rate, some of the promotions right now are pretty good that you could win. There's not that many more hikes coming. It's more likely that we see rate cuts in 2024. So I would lock in until 2024, maybe 2025 for the peace of mind at the same cost as variable, might as well. But I think over a 5 year period, variable is definitely going to win. So the time to lock in was last year, and you've missed that boat. I locked in one in the summer, and I'm thankful that I did. Good evening, folks. Hey, good evening, Ford. Mike says, what did you end up selling that sixplex last year at? Would have been an Airbnb monster for you right now. Would have been. So we sold it originally for 1.43 million, and the buyer walked away. They tied it up and wasted it. And I sold it to another person at 1.32, and they tied it up for 60 days as the market fell. And I gave them extension after extension after extension, and they wasted my time. They walked away. And then I eventually sold it for 1.15 with a lower commission because I was sort of the exclusive agent on it. But I did pay a buyer's side commission, and I had a great agent that helped me bring a buyer to it. So 1.15 is what we got for it, which sucks. Now I bought it the year before for 537,000. So I bought it off MLS the first day it popped up in the commercial MLS. I walked in and gave him full price. I was like, I don't even need to see it. He said, do you want to book a showing? We can't get, it was a hard one. They're like, the tenants won't let anyone in for 48 hours. You can see one of the units. And I was like, I don't need to see any of the units. I know where it is. The land alone, I'm good. It's a legal sixplex. I went and called the city. It's all legal. I'll buy it right now. Full price, cash, firm. And it was like, that was how I got that deal done. But 537,000 for a sixplex in Byron, average unit's 200,000 a unit. It sucks that I sold it at a time where, you know, I just wanted to get out, and there was panic and fear in the market. I probably could have got 1.2, 1.25 for it, but it was a, you know, pretty easy transaction. I took the cash and I bought more properties, and so I have no regret. I took that money and I bought a bunch of other properties. As an example, we're buying a Muskoka cottage, just one lake over from Lake Rosehart for 192 grand. So it's a 1,100 square foot bungalow with like 12-foot ceilings. Now it's a weird, quirky kind of property. It's not quite on the water. It's one back from the water, but ARV of like 550. So I take that money, that 1.1, and I roll into other deals. I make a ton of money. So for me, it's just about like churning my capital around. That's because I have a plethora of deals to chase and to fund. And so for me, it's about, you know, keeping my money moving. And I get that most people don't have the deals that I have and don't want to spend the time to do that and fix properties up and go through all that work. And so they would hold a stabilized property. And that was who bought it, was a large institution that holds stabilized properties. Good evening from Nova Scotia. Hey, working assets, real estate analysis tool templates used to be free on the website. Tool templates. So you're talking about like my tools, my Excel tools. I sell them very occasionally for like $60 per Excel spreadsheet. I have a deal analysis tool. I have a bookkeeping tool that I also sell. Occasionally I'll sell them for like the two of them for $120. Very rarely. It's just not worth my effort to send them the thing and go through all that work. But I'm going to start coaching again. I'm going to start a mentorship coaching program, I think. I've got to decide how I'm going to do it. I think to start, I might just do some coaching with people, like some one-on-one stuff. But yeah, that's coming. It's coming. And this recession, I can't not. It's, if I can make a couple $100,000 coaching with people and I can enjoy doing it and it's fun, that's like doing a couple deals. If I spend the same amount of time as I would do on the deal or two, then it's like I can take that, I can invest that in something like Bitcoin, and then Bitcoin's going to 8x. So it's like that $200,000 could become $1 million or $1.5 million in the next bull market. So I'm like, I can see the incentive to do it, even though it's inconvenient for me to do calls with people. I enjoy, for the better part of it, I enjoy helping people and I enjoy teaching and giving. And so it aligns, it makes sense. It's something I can do in retirement that I enjoy. So that's probably coming. At a minimum, I'll be doing coaching calls. My coaching calls like $300 a call now. I can do 2 calls. Well, because of my brain time to relax, I can't do 2 calls in an hour, but they're 30-minute calls. So usually I do one and I spend 30 minutes like refreshing and thinking about it. And I spend time in my brain thinking about their problems before the next call. So you're really on the phone for 30 hours, but you're spending an hour of time. So that's roughly what I was doing. I was thinking I'll bring that back. Probably going to do it though, instead of a per call charge, like not unlimited, but a set program where we talk on a monthly cadence, have weekly group calls. I give them everything. And we do deals together and we partner up. And so there's ways that not only can I make a coaching fee and build a business out of that sustainable, where I can hire staff and build something robust that we can record and then maybe give away as a part of this program to future students, but also I can do deals together with the students. And so they can go out there and they can use my methodology of thinking and find opportunities, bring them back to me, and we can both profit 50-50 on those opportunities. And so there's just more mics running around, the same mindset, we get so much more done. So that's the real motivator. That's where we get the big pyramid and make a lot of money. So that's where you build the army and then they're hunting and it can be juicy. Bum, bum. Lucas says, I'm locked in for 2% for the next 5 years of student rental that's cash flowing. Awesome, that's great. A few extra payments each year. I wouldn't pay down debt. Like if you have debt at 2%, pay nothing down. Keep as much cash as you can and pay as little down as you possibly can. Don't pay that down if you're locked in at 2%. Keep that cash, invest it, have that cash reserved to buy the dip. Don't put it into a mortgage that gives you 2%. You can go buy bonds right now, like Bell Canada, corporate, like quality bonds right now that pay like 8% yield. Why would you ever pay down a mortgage at 2%? Keep as much of that as you possibly can. Pay back as little as possible. Take that money and invest it. Instead of making a 2% return by paying down that debt, you can make an 8% return in bonds. You do private lending, make 12, right? Like, no, don't do that. Hayden, no problem. Happy to help. And then Eric says, buying a place in Florida, Southwest Florida, wait for prices to come down. Right on. Eric, yeah, I mean, definitely. We're going to buy a whole bunch of properties in Florida. It's hard for me to want to buy a property in Florida only because my mom works at Marriott. And so I get to stay, and I'm a platinum member with Marriott. So when I stay at like a full service Marriott, a JW, any of the nice ones, I get access to their concierge lounge, which means I get free breakfast, free lunch, free dinner, catered. And so it's hard for my family of 5 to all get fed. And then I use my mom's promo code because she works at a call center. She makes minimum wage, but she's able to, that's one of the big perks. And so I'm able to stay for like under $100 a night at like $1,000 a night hotels, then get free food on top of that. So the cost of the food is the cost of the hotel room. So I stay for free. My housing cost is 0. And so it makes it really hard for me to want to buy something when I have that perk. And platinum members, because I stay 50 nights a year. And that's just because every year I end up using the hotels. And so because of my lifestyle, it lends well. But when I can't find something, I have to jump around from hotel to hotel to get the blackout dates, but I'll also just shop around. And so it can make sense to have a property. For me, not right now, but when I build a portfolio down there in Florida, I might occasionally, the odd night here or there, use the Airbnbs that I have if there's a vacancy. Like as an example, if we have a 3-day block where there's no one in the unit, and we have a stay for a week and a stay for a month or something, there's a 3-day period, I might use it and pay for the cleaning fee myself. I'm not going to hurt my revenue over it, but occasionally, yeah, I would use a property. Thanks, Miguel. Jim says, no, I don't think so. Lucas says, thoughts on chat GPT with the AI. Oh, I shared that on my Instagram. AI tech lead the next bull run. Yeah, so I don't know, how do you invest in chat GPT? It's really cool. It's a software, basically. You could plug in like you could like copy and paste a really complicated math question or something that's on a test, and it will solve it for you and say answer is C. Like, it's the smartest AI. It's going to change the world. Humans become less and less valuable. I think I answered all the questions. I gotta go. I gotta go help my daughter. It's been over 60 minutes. Thank you so much for watching, everyone. I appreciate everyone who tuned in. Hit the like button. If you're on the replay, let's connect. Get in the comments section. You know where to find me on Instagram, on Facebook. My email is rosehartcoaching@gmail.com. So let's link up. Let's do some deals together. Let's have a good time. Oh, I missed a question. It says, what cities are catching your eye for arbitrage right now in Ontario? I don't know. Like, I have a competitive edge in London, but I'll buy anywhere that it makes sense. You've got to have logistics nailed down in that city first. So most important is logistics. Do I think any one city is better than another city? No. Like, I know people who are crushing deals 60 cents on the dollar in Toronto. I know people who are doing the same thing in Vancouver, people who do it in Chatham, all over the place, Sarnia. So I go where I have infrastructure in place, where I can have a competitive advantage from a renovation cost perspective. So I don't have teams built out in Toronto or Vancouver, so I don't buy properties there. Just don't. Anyway, thank you so much for watching, everyone. Go where it makes the most sense for you. Try to buy stuff that cash flows if you can. That's arbitrage. Arbitrage and deal. You buy a property 60 cents on the dollar, you renovate it. Oh, Airbnb arbitrage. Okay, sorry, I missed that part. I thought you said arbitrage. Because arbitrage is different than Airbnb arbitrage. For Airbnb arbitrage, you can do it in any city. It works better in bigger cities. So as an example, in Vancouver, it works really well because the $2 million house rents for $8,000 a month. And so the price to rent ratio is really in your favor in a large major metropolitan city. So rent arbitrage works best in the most overpriced cities. There's, of course, challenges with bylaws and things like that, and people have ways to get around them. As an example, if you're renting it as a tenant, you don't really care if you can convince the landlord to deal with it. There are ways around. I know a lot of people who are doing the arbitrage in those cities, in places like Vancouver, outside of Vancouver. You can pick it in the GTA. There are places where you can do it. Burlington, as an example, has no Airbnb restrictions at all in the GTA. So I would pick a large city if I was going to do it, but you can do it in any market. Anywhere you can arbitrage. So get out there and do it. All right, everyone. Thank you, everyone, so much for watching. The secret to building your wealth, three things. Gotta be slick. I mean, you can definitely do it legally too. Spend less, earn more, and maximize returns in the difference. Bye, everyone. See you next week.